I have a joke for you guys first.
Good.
What do tickets cost to see Coldplay?
$100.
Half of everything you own.
Your house and your house and half of your 401k.
Wow.
Right,
I mean,
next
the
week,
arc of this podcast is amazing. We got all the way back to the beginning. Nice work.
I'm going to bring it full circle.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right. Welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, July 18th, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
So funniest thing that happened this week, I don't know if you guys saw it. Coldplay hasn't produced any singles.
Wow.
Until what happened this week. Did you see that? I mean, so apparently this CEO is having an affair with the head of HR of his firm, and
that's always a good start.
They get caught on the big screen during a Coldplay concert this week. I thought that was pure gold. So anyway.
Wow.
The memes all over Twitter are just hysterical right now on this, But
I didn't even know Coldplay was still around, to be honest with you. But
they have so many bangers. I mean, there's so many hits that they can play. They can easily play a set of for a couple hours with all the.
I think this is their farewell tour.
I was going to say, is this like a comeback tour? Because they're kind of like right on the edge. They're not popular anymore, but they're coming back. I mean, I don't know. Like, are they? They're not Billy Joel, that's for sure, but they're also not Taylor Swift, right? So,
well, I'll say that was the most interesting cold open that we've had thus far. Nice work, Neil. Yeah. All right. Well, on to the Fed. Speaking of things that are swampy. Where do you want to start with the Fed? You want to start with the race, the two-horse race for Fed chair? You want to talk about, thoughts of easing? What do you want to talk about?
It's unfortunate that it's a race only between two people, the two Kevins, Kevin Warsh, Kevin Hassett. If I had to pick between the two, I would probably go with Hassett, but. I don't think that that's really the best pick that the president, especially. I mean, I guess the question is like, what is the president's goal, right? If the goal is just lower rates, there are a lot of people that can give you that, and they can do it in a way that gets a lot of other people to your side. The issue is if you put in someone like Hassett, who's basically coming from Trump's immediate personnel orbit, the risk is that he looks pliant, like a toady. I mean, this isn't the same Kevin Warsh that ran the economics department at the American Enterprise Institute like 20 years ago.
Kevin Hassett.
He's been someone, Kevin Hassett. He's been someone that's been working and sort of in Trump's orbit for the last decade. And look, I mean, I think there's a real open question about whether he would be the guy to make a convincing argument to persuade the colleagues on the FOMC in favor of lower rates. I mean, he's going around talking about like cost overruns for the Eccles building. I didn't see him talking about that before. This is obviously something that's been going on for a while. What you want to, I mean, I still think that Governor Waller is the best pick for a number of reasons for President Trump, because he guarantees you more seats to fill. You have to look at this like SCOTUS. If you want to leave your mark on the Supreme Court, you want to fill as many seats as possible. If you want to leave your mark on the Fed, you want to fill as many seats as possible. Putting in someone like Waller gives you that opportunity. Now, if you put in Hassett, there's some chance that Powell doesn't leave. I mean, he might, but you're making a risk. One way of doing it, if you really want to go with Hassett, is you basically put him into Kugler's seat. You maybe give him an opportunity to make an impression on his colleagues, and then, when Powell's term is up in May, you elevate him to chair. But again, I just think that it's it's about being able to debate your colleagues and go around the table and make your case. If Hassett gets in there and he's talking about cost overruns and things like that, I mean, it's not going to be a particularly compelling rationale for the folks at the Fed.
But part of their their conversation now is about Fed easing, right? And you mentioned that they're going to be toadies of the president. Yet when you look at the PPI data, which suggests that the PCE data is right in the wheelhouse for the Fed to cut in September, you're not that far off of what they're talking about, right?
Well, it depends. I mean, there's no credible economist that will tell you that they should lower the rate 30. What is it? 3 full percentage points. That's kind of where Trump is at right now. There's no credible economist that will make that argument. There's also not many credible people that'll say the reason to lower rates is to improve the cost of financing the government debt. That's also not an argument that is made by anyone, I think, that's credible. I mean, if you look at, Waller's talking about basically shifting dynamics around growth, but you're not going to be able to persuade anyone in the committee that the reason to lower rates is because of government financing issues. But you're right that Waller is out in front, but a lot of his colleagues are frankly not that far behind. So I do think the Fed will cut rates this year. I think they're moving in that direction. And while I don't think July is likely, I think the economy remains in a very sort of tricky equilibrium, a shaky equilibrium, and I think it makes sense to ease policy this year. And I think there'll probably be enough evidence on board to do that by September.
So it seems like we're sort of barreling towards, September, October timeframe. We've got the risk for a shutdown, which, Steve, I think you're out in front on in terms of, highlighting that to clients. You put that in the notes this week. Neil, you're talking about, this about a Fed cut. And then Jeff, we're going to be right into the part of the seasonality chart, which says October is going to be a little softer than, the rest of the year. So Steve Pavlik, start with you. Government shutdown risk.
I still have it elevated when I would say about 60%. I think looking at Polymarket, it's 40 or 42, depending on which contract you're looking at. Again, this is separate from the One Big Beautiful Bill. This requires 60 votes in the Senate. Republicans only have 53. And you go back to March, where you had Minority Leader Chuck Schumer, the political blowback for how he handled it. I just think there's a lot more pressure on Democrats this time to quote unquote shut it down. Now, if they do that, the question is going to be, how do you reopen it? The thing to watch is going to be when lawmakers adjourn for August recess. That's when they're going to be at home hearing from their constituents. And that's where they're going to really get the message whether or not the base is behind shutting this down. So right now, that's sort of where I have the call. I'm going to watch to see when lawmakers return September 2nd, what they're saying, because that's going to reflect what they were hearing from their constituents. But it's going to be important to watch moving forward. There really aren't that many legislative days between now and then. And I would just say quickly on the Fed situation. I don't know of any president that ever wanted to put in a Fed chair that wanted to raise interest rates. So I don't know that Trump's necessarily unique in that regard. I will say, just having spent my career in Washington, most of these jobs aren't based on meritocracy. They're based on loyalty. And people might not like that. I'm not advocating for that, but I think that's just sort of, it is what it is. It's probably even more the case with Trump. So if that helps.
It is unusual to put a litmus test on this, though, in this way.
It's the way he's gone about it publicly. I don't disagree with you.
No president has done it that way. I mean, I'm not saying, I agree with President Trump that rates should be lowered. I don't know about 3 full percentage points, but this is a litmus test. But I'll push back a little bit. Trump's first pick, Powell, wasn't a loyalty pick. It was a he wanted to cycle out Yellen, and so he kind of went with someone that, I mean, and he's justifiably somewhat, I mean, in his own mind, justifiably reluctant to do it again, right? Like, so that's probably the knock on Waller.
I think that's right.
But Yellen also wasn't, when she got nominated, she wasn't loyal to Obama. I mean, she wasn't even on Obama's. I mean, I think he plucked her.
Wasn't
She was at the
CEA
San
chair?
Francisco. Not for Obama.
Maybe it was under Clinton. Yeah, just coming from the establishment. I think I would, I guess, take.
I mean, he was toying with Summers, actually. I mean, that was the whole. I mean, Obama was trying to make Summers at one point who ran the NEC under Obama, and then he got enough pushback from the Senate, and that's really the issue. Is like, will Senate Republicans actually grow a spine? I mean, that to me is an interesting kind of thought exercise, because what's the incentive for someone like Tom Tillis or Susan Collins or Lisa Murkowski or Mitch McConnell to just green light whoever Trump puts up there? I mean, this is is monetary policy going to be the thing that like Charlie Kirk and the base of of Trump's party will die on? Are they going to die? Are they going to die on the Kevin Hassett hill? Honest question. To me, it's like, it's easy to grow a spine on this. Like, Tillis can just be like, nah, you're not getting whoever you want. Like, what's the downside for him? I mean, the jig is already up on his career. And for Collins, it's like, look, I showed you that I stand up to Trump because on this issue, I went against the guy that he wanted. And she's up for re-election next year, isn't she not? So
she is in
I don't
Maine.
know. I just feel like if Senate Republicans grew a little bit of a spine, maybe Trump doesn't get whoever he wants through the finish line.
That's a big if, and I'm not sure that's going to happen between now and next year.
So, Jeff, we've in some of this policy uncertainty. You obviously highlight seasonality often, not as a reason to be invested or not invested, but as a sort of a tangential part of your process. Where are you with all this?
Yeah, you always look at that, and July and August are traditionally pretty decent months. If you look at September, that's traditionally the weakest month, and that's not that does not get dismissed because we had a decline in the first half of the year. So September still kind of stands out as the boogeyman, if you will, of any month of the year. I think it's interesting what Steve's saying because it's not priced in the market. So even though Polymarkets, and I can't really remember a point where that's happened, Polymarkets is saying 40%, Steve's saying 60%, and the market's saying, what are you talking about? So how do we know that? Well, you look at the implied volatility around the term, what's called the term structure and options, right? So how much are people paying for options in July? How much are they paying for options in August? How much are they paying for options in September, October? And what happens is as you go out further, because there's more uncertainty as you go out further, that term structure rises, right? The price of those options rises. What ends up happening historically when you get these kind of dates, and they're almost always policy related. In fact, you can see it right now in the options market with tariffs in August 1st, is you get this spike. And that's because there's this deadline and this concern. And so those options get bid up. And then the back half of those options past that deadline tend to go down because they believe that policy will get resolved. We're not seeing any of that in, around the government shutdown. So I actually think there's an opportunity to be long, call it October 15th or whatever the expiration is on those options, looking at that as a, potential for the market to kind of catch up, or the consensus to catch up with some of these quirks in the calendar that happen around this policy. So we'll see how it plays out. But certainly there's a focus on tariffs, and I just don't think the market's kind of moved beyond that to see what's happening with the potential for a shutdown. And that plays right into seasonality. So it actually bodes well. The other thing I would just say from a seasonal standpoint, and this is something that we've been really leaning into over the last month, is this transition away from beta. And it doesn't seem like it's worked. Beta's been working still, but beta's in the 100th percentile. And in other words, the performance of beta, high beta names are outperforming low beta names as much as they've ever in the history of our data, 25 years, outperformed. And that's coming off of a zero number that was back in April, right? That was in the 0th percentile. So what's interesting is beta actually does have seasonality as well, and that tends to peak right here, and you have weaker beta going into it. So there's kind of this confluence of things happening that take a little bit of risk off the table for us and start focusing more on momentum names than the beta names. And I know we've talked about this on the pod before, but we're still there. And I would just say the seasonality for momentum, believe it or not, actually improves here. While the seasonality for beta goes down. So there's a lot of things, kind of moving in the same direction. Steve, is there anything on the crypto legislation? I know this is crypto week. Obviously, Bitcoin's had a nice move, very close to our price target of 125. Still looks good. I'm a little concerned tactically about kind of fade the news type of event that things lead up to this. But the positioning from the commitment of traders data still shows commercials net long futures, which is good news. But what are you seeing out of the legislation? Any surprises? Anything that we should note?
Sure. So I wasn't surprised that the three bills passed. They did have some varying level of Democratic support. I think the most timely would be the Genius Act. That was the bill that had cleared the Senate before, because that's actually going to be signed into law later today by President Trump on Friday. So that's going to be good for stablecoins. What I was really watching was this Clarity Act that would provide regulatory framework for digital assets beyond stablecoins. This is not going to be the version in the House because the Senate hasn't worked on its version yet, but the fact that it had a much larger amount of Democratic support, I was sort of, looking at 70 or 80 Democrats to more be the barometer there of, is that going to be an indication of where the support's going to be in the Senate? It's actually over 100. And I think that really just bolsters the case that it's not if, it's when we're going to get this legislation. I know that Senate Republicans are trying to get that bill done by the end of September. I think for the government shutdown reasons we talked about in the stopgap, it's going to be difficult. But would it be surprising if they got it done by the end of the year? Probably not. I think that's probably a more realistic time frame. And I think it's important to make the distinction that it will be legislation, because that's not going to be as quickly undone compared to executive action. You could have another Democratic administration coming in. You saw they're more adversarial to crypto under the Biden regime. So the fact that legislation is more durable, particularly if you're going to have support from amongst half the Democratic caucus, to me is just a very encouraging sign, and perhaps may have been reflected in some of the movements this past week in the crypto space.
Yeah, well, it is moving beyond. I mean, Bitcoin is kind of the standard bearer here and still in the uptrend. Ethereum less so, but even being impacted more favorably as well. So certainly there is this knock-on effect that's going on and taking place. And I would just say too, not at the expense of gold, not at the expense of silver, not at the expense of some of these traditional hard assets and currency. Surrogates, if you will. But that brings me to a point that I think is worth talking about. I don't want to belabor it because it is a little high level, but we are seeing, and 2025 has really been a feature of this. We are seeing a world in which you're seeing higher rates equate to lower bond yields, or I'm sorry, lower currencies. Good Lord, higher rates and lower currencies, right? So usually it's just the opposite of that, where a little bit of the chicken and the egg, but the idea is that interest rate differentials. If your neighbor has higher interest rates, you will use your currency to then buy those rates and get a better return, right? And that forces the currency up. So that tends to happen, but that's not happening here. And the reason I bring it up, and this is not to hit the panic button, but I think it has to be talked about or at least recognized, is this is really the manifestation of what Ray Dalio and some of these kind of macro bears have talked about, which is when you lose confidence, right? I mean, if you think about it in simple terms, if you had two banks and one bank offered 3% on your savings, another bank offered 6% on your savings, you choose 6%, right? Well, you choose 6% unless you thought the bank with 6% was going to fail and you're only getting 95 cents on your dollar, right? And so then you wouldn't choose the 6%. And that's a little bit what's happening here, where we see this weakness in the currencies of sovereigns, that would include the U.S., where the rates are actually going up. And so, again, that's not panic button. That could be tariff related, et cetera. I think Japan is much more of a focal point of this, given their debt to GDP and everything else. But it is something that's different than what we've seen in terms of the history of how this has usually played out. And I just think it's worth noting. And it's worth noting too that as this is happening, you're seeing gold rise, you're seeing crypto obviously gain more familiarity, more traction, more credibility in this environment. Neil, I know it's a big macro thought, but where do you come down on that?
Well, we went in. I mean, so what I was looking at, and we wrote about this earlier in the week for our clients, but you have a situation now where nominal growth, right, is running below nominal interest rates, and so if I look at that, I mean, there has to be some kind of release mechanism, right, in the markets if that's the case, and you would expect, obviously, then the dollar would get rinsed in that situation. I mean, but when you look at the data historically, there's not much evidence that it breaks one way or the other. There have been periods where, when you have that situation where nominal growth is below nominal interest rates, the dollar weakens. There have been times when the dollar's weakened with nominal growth above nominal interest rates, like the 2000s. So there's not one uniform kind of tell, I guess, or signal in the marketplace. So
and that's true with equities too. I mean, when people try to make equity market calls based on the dollar, like, good luck. That is a 50-50 at best. What you're hitting on, which is interesting, is that's kind of the growth differential story, right? So there's 4 factors that drive currencies, yada yada yada. That's all academic, but growth differentials are one. Usually, interest rate differentials that spread between my rates versus the other country's rates is the big driver, but you do get these growth rate differentials as well. So anyway, it'll be interesting to see how this plays out, but we're obviously watching Japan very closely as kind of the litmus test of, is this getting to the point where people are now really looking at this like, hey, how are you going to service your debt? Are you going to be a good steward of my capital, or are you just going to end up inflating away your problems at my expense? So,
and their debt to GDP is what, 200%, I think, compared to.
It's a crazy number.
I think it's like 200%, twice as big as ours. Let's stay overseas a little bit. Talk about chip diplomacy. NVIDIA, Jensen Huang, working deals for not just his company, but maybe easing tensions between China and the U.S.
Well, if you go off the reports, Wang met with President Trump and sort of made the case that, hey, it's in the U.S. interest to make China more dependent on U.S. companies rather than Huawei for their chip needs. And I think go back to what was sort of the Geneva framework in May. This goes back to that use of export controls. Our point of leverage over China is access to these sophisticated chips, and China's been using the rare earths. So we'll sort of agreed to last month and announced was that basically China would ease up on their rare earth restrictions in exchange for us easing up on our chip restrictions. So I think that's just what's being reflected here. I guess the risk associated with this is it's going to really be dependent on productive dialogue moving forward. So if you see a deterioration in that, could these restrictions snap back at some point? I think, I'll say it again, I think talking is better than not talking, although with China, there's always a risk that they're just trying to run out the tape and continue to delay things. So put that caveat there. But I think that's what you're seeing with respect to China. Now, in the Middle East, we saw when President Trump went over to visit, there was a lot of optimism with respect to AI investment in semiconductors there. And now there's some concern amongst the Commerce Department and some of the national security hawks about providing sophisticated chip technology over to the Middle East, because sort of, where does it go from there? And I think that's sort of one thing to watch moving forward as you try to realize some of these terms that have been announced. There is a security element to that. And so I think that's one reason for caution when you start looking at it through that lens.
Thanks, Steve. Obviously, folks, we do a lot more than just this pod. So if you like what you hear and want to see our work, whether you're an institution or individual, just go to RenMac.com and it'll guide you whether you're an institution or an individual. So 20 minutes in or so, let's bring in Harry Chen, the mailbag man. Good morning, Harry.
Okay, today we have the question from Carl Connor. The question is, how will the weakness in the single-family home for sale market affect the single-family for rent and apartment market? Thank you.
Neil, I think that's you.
Yeah, well, that sounds like a question for me.
The excitement level is unbearable.
Well, I mean, why should you be excited? We're talking about housing. That's probably the one area where there's absolutely zero ambiguity around what the direction of travel is right at the moment, which is, in the economic data, lower. I mean, we just had a single family residential real estate, number today, single family building permits. They're down about 35% annualized over the first 6 months of the year. So, that's a pretty steep decline historically. So, what's happening with home builders right now is a situation where inventories, unsold completed inventories, continue to rise. That means that they have to rationalize, their starts outlook. And sales remain sluggish because interest rates are too high. So they basically have to bring starts in line with sales, which means starts will continue to come down for single family builders. They're making more price concessions, and ultimately that's going to matter for rents, because rents follow the value of the underlying asset, right? So if home prices are declining, which they are, by the way, nationally, according to Zillow, they're down, 4 months in a row now, about 2% annualized over the last 3 months. The fact that home prices are declining, that probably sets the table for ongoing weakness in rental inflation, which is an encouraging story if you're, looking at the inflation process, because rents tend to be sticky and they tend to, be more persistent than goods prices, which tend to be more flexible. But rental inflation will likely continue easing as a result, because the underlying value of the asset, in this case homes, are deflating in price. I think what's important for the economy is that the prices are declining in the places where builders make the homes. So that's really where the prices are falling the most, right? Like, so Florida, it's like falling at 2 or 3 times the pace of the national average. You see that in Arizona, Texas, California, Georgia. These are all states where the prices are declining more rapidly. And these are the places where home builders generally have been making the houses, right? In the Southeast and in the West, where there's a lot of available land to build the homes. So, to me, it's residential investment is something that we've been kind of very cautious on. We remain cautious on it. And the question really is, to what extent, at this point, does the weakness in housing bleed into other areas of the economy? That's kind of what we're looking at the moment.
Thanks, Neil, and thanks, Carl. We'll get a nice trucker hat out to you in short order. Appreciate you submitting.
The one thing I would just add to that is, if you look at the stocks of multifamily, I mean, they look bad. The multifamily REITs, they look bad. I mean, the home builders have rallied, but they've rallied right back into resistance and actually look pretty vulnerable here. But the kind of break and the rollover that you're seeing in essentially apartment REITs is pretty dire as well.
Yeah, I mean, you could probably talk me into if you break ground now, like maybe in 2027 the market's better. But if rents are falling, I mean, that sends a pretty important signal to anyone thinking about making a multifamily building. I mean, you're not going to make your money back, especially with interest rates this high. So why bother making it in the first place?
I wonder if that's New York related with the potential new mayor. Multifamily.
Yeah, we can get into that next week.
Next week's topic. All right. Speaking of next week, let's.
Yeah, you know what that's good for? That's good for New Jersey, Connecticut, and Westchester County real estate. I'll tell you that.
I got a house for you if you want one. Let's.
I mean, I thought De Blasio was going to do it. De Blasio did a pretty good job for my real estate, but this guy, damn.
Yeah, it's going to be a fun race to watch.
Well, his mother is actually a very good director. She's a movie director.
Oh,
so she makes make believe for a living. Okay.
Her name is Mira Nair, I believe. She directed a few. I only know this because she's Indian, but
She was there's
Bollywood?
a decent. It was pretty high level, but it was a decent expose on him. I think a week or two ago in the Wall Street Journal weekend edition, which, by the way, is the best edition of the Wall Street Journal. I know, because we all get our news from Bloomberg or what. Like, you get your news all the time, every day, like up to the minute. So, like, why do I read the paper in the morning? I basically don't. There's like opinion section, some other things, but the Wall Street Journal weekend edition, I set aside time and I read the stuff that just has nothing to do with our business.
You are probably one of the few people in the last 24 hours that has said something positive about the Wall Street Journal.
I'll tell you who didn't say something positive about the Wall Street Journal. Can guarantee that one. All right, next week, the last full week of July. Steve, what are we looking at?
Waiting to see whether the House is going to stick around. They're actually supposed to adjourn on Friday for the August recess. There's talks that maybe they'll get out earlier. The Senate is going to try to move their first appropriations bill. This will be a good test case when we talked about what the political dynamics might be at the end of September around the government funding bill. This is the first of 12 that Congress is ultimately supposed to do. They're not going to do it because both the House and Senate are supposed to pass their own versions, then reconcile them, then pass the compromise version. It's just not practical to happen before September 30th, which is why you're looking at that stopgap needed, which is why you're looking at the elevated shutdown risk. And then on Sunday, I'm going to be watching the election results there in Japan. Is the ruling LDP party going to become a minority government? If so, that's not necessarily unique around the world, but I think it'd be relatively unique in Japan. And there should be some implications there, kind of what Jeff was speaking about earlier. And then we'll see if there's any more announcements here on the trade front. And I'm assuming that Trump's not going to fire Powell next week, but we never know. So we'll watch that as well.
So you're saying that Washington's not going to move quickly on 12 bills? They're not going to move quick? It's amazing.
I always say take the over on time, the under on results when it comes to Washington.
Neil, what do you got on your horizon?
I have a joke for you guys first.
Good.
What do tickets cost to see Coldplay?
$100?
Half of everything you own.
Your house and your house and half of your 401k.
Wow. I mean, the arc of this podcast is amazing. We got all the way back to the beginning. Nice work.
I mean, bringing it full circle. We got a few important data points. We'll have manufacturing PMIs coming out. The S&P Global is going to be releasing that data. Generally speaking, it looks like July manufacturing sentiment has been improving relative to June, but it's an open question about these surveys because they're obviously very sensitive to like what's happening on the trade front, right? So maybe some of the survey responses came in before Trump started handing out letters to everyone talking about reciprocal tariffs going into August 1st. There remains a lot of currency in the idea that Trump will walk back a lot of his threats. We'll also get data on housing. So existing home sales, really not much going on, kind of stuck in the 4 million range. And new home sales as well. I mean, everything we know about the builders is telling us that June is probably not going to be a great month, but it's also important to kind of think about the wiggles and the squiggles in the high frequency economic data flow. And we had a 14% drop in May. So the question is like, how much do you rebound off that? I mean, if you fall more from, again, after a big drop like that in May, I mean, that would be quite something. So I still think the underlying trend is weaker, but at any rate. And then we'll get some data on durable goods at the end of the week, looking at sort of a core reading on business investment.
Jeff?
Well, it's continues to be earnings season. So far, earnings have beat about 88% of those reported. Now, that was kind of the first week. It's a busy week. There's no real clear lean. It was pretty heavy financials last week. What was interesting is you had beats and then the market didn't really respond, or the financials didn't respond well. Initially, they started to come back a little bit. So we'll watch those reactions to news and play that kind of what we call the game within the game. There's the expectations game, there is the release, and then there is how do those things trade after that. So that ends up being important and something that certainly we keep our eye on. I continue to look and kind of methodically move away from high beta, low momentum names. I think that's going to be important for portfolios, particularly if we get some consternation around this government shutdown idea. Beta will get hit in that for sure. So I want to be extra careful on that. And I'd just be vigilant around the dollar. Dollar's, obviously been very, very weak. But if we start to look at where some of these consensus trades are and the number of bulls or lack thereof for the dollar, but the number of bulls in, say, yen, or number of bulls that are in the euro, they're pretty high. And I wouldn't say that that's going to change the trend at all, but certainly they are ripe for some type of short squeeze. They are crowded shorts, in other words. So I'd just be a little careful on that as we proceed over the next month or so.
All right, well, let's end it there. Thanks, guys. A reminder to everybody, go to renmac.com for more information on what we do and how we can help, and get yourself a trial if you're not already a client. And follow us on Twitter. Always like the likes or the comments. We follow those. And of course, follow us on Twitter as well. So until next week, when we'll be 1 week older, 1 week wiser, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Have a great week, everybody.